Three key messages this week. Firstly, a review of global markets. Secondly, an update on recent economic data and the implications for the pound. And then finally, a look ahead to the forthcoming US elections in November. Let's start with markets. After the summer rally, global equity markets have continued to trade in a sideways pattern. In fact, over the last 6 weeks, only 4.5% separates the high and low on the FTSE 100, and in America, only 2% separates the high and low for the S&P 500. Dig a little bit deeper, however, at a sector level, we're starting to see some interesting sector rotation. Defensive sectors which have performed very strongly year to date, given back some of their gains in favour of the more cyclical, economically sensitive parts of the market. We've used this period of relative calm to rebalance our client portfolios, taking profits on assets and sectors that have performed strongly and redeploying the cash proceeds into areas of the market where we see attractive valuation opportunities. This week saw the first signs that the initial jolt to the economy following the referendum is starting to subside, with the release of stronger than expected data from the services sector of the economy. This follows a sharp drop in the sentiment survey in July. It's probably too early to draw any hard conclusions from this, but what we suspect is that the initial pre-Brexit fears of a deep recession are not yet being reflected in economic data. As for how much further the pound can rally in the short term, we think near-term appreciation against the US dollar may be limited, as the US remain on an upward path to raise interest rates, while the Bank of England remain open to the possibility of a further stimulative cut to interest rates. Finally, there are now just 2 months to go until the US elections. Our long-term belief is that economic factors generally outweigh political ones. However, that won't stop markets reacting in the short term to any polling predictions that come along. To help our clients understand the investment implications of the US election, we're publishing an article later this week detailing the main policy divergences between the two candidates and the potential short and long-term investment implications. In keeping with our investment principles of looking to add quality assets at discounted prices, we would look to use any election-induced volatility in markets to add to attractively valued assets in our client portfolios.